We are back for session 2, launch seminar of the publication on roadmap for developing an online platform to track non-performing loans. So to deliver the opening remarks, may we call on the Mr. Albert Park, the Chief Economist and Director General Economic Research and Regional Cooperation Department at the ADB. So welcome, Albert.
Welcome, everyone. Dr. Steen Claessens of the Bank of International Settlements, distinguished IPAF delegates, government officials from ADB developing member countries, distinguished panelists, ladies and gentlemen, good afternoon. This afternoon, we're very happy to launch a new report on how we can develop an online platform to trade non-performing loans, or NPLs. This couldn't come at a better time. At the end of last year, NPLs held by banks in Asia and the Pacific remained considerably higher than before the pandemic in 2019. This could in fact worsen as we continue to deal with negative economic shocks severely affecting economies and financial markets around the world. The pandemic recovery, the Russian invasion of Ukraine, and global monetary tightening could lead to economic slowdowns and a possible global recession. Many central banks have been raising interest rates to tame inflation, which can add additional stress to borrowers. As we learned in the aftermath of the Asian financial crisis 25 years ago, asset management companies were very useful in helping clean up the balance sheets of banks. Today, there is potential to do this even more effectively by developing an online marketplace for trading NPLs, which can help banks dispose of their NPLs and allow them to continue lending to those who still need financing. Further developing and deepening NPL markets was already on the policy agenda prior to the pandemic, but today we have better tools to swiftly resolve bank NPLs efficiently. Just as for many economic activities, taking advantage of the ongoing digital transformation is central to staying competitive. As the NPL industry prepares for a wave of new deals and opportunities, we must use available technologies and platforms to facilitate the process. This is why we at ADB have decided to examine the feasibility of establishing an NPL online platform to help NPL transactions. The result of these efforts is the publication we're launching today, Roadmap for Developing an Online Platform to Trade Non-Performing Loans in Asia and the Pacific. This report assesses the region's demand and readiness to establish an NPL platform. It details potential benefits and explains how it could ultimately help countries improve their financial stability. We had quite a lot of support from partners who provided many helpful insights in interviews and in surveys. So on behalf of ADB, I'd really like to thank all IPAF members, the IPAF Research Committee, European Banking Authority, First Financial Network, and the International Finance Corporation. We are also honored this afternoon to have Dr. Steen Claessens deliver the keynote presentation. Dr. Claessens is Head of Financial Stability Policy and Deputy Head of the Monetary and Economic Department of the Bank for International Settlements. He works with the Financial Stability Board, the Basel Committee on Banking Supervision, and the G20. He spent time at the World Bank, at the IMF, the US Fed. He taught at the New York University Business School and the University of Amsterdam, and has authored many distinguished academic publications. Today, he'll speak on safeguarding macroeconomic and financial stability through regional cooperation and integration, and also discuss the importance of dealing effectively with NPLs. In closing, I hope that the report that we're launching today will be a useful reference for developing the region's NPL markets and help lead to greater financial stability in the region. I also hope that this report can serve as a springboard for further study of more specific operational details related to NPL trading platforms. Thank you very much.
Okay, thank you, Albert. Now, we'd like to welcome our keynote speaker, already introduced by Albert, Mr. Stajin Klassen from the BIS, and he's joining the virtually. So please welcome Mr. Stajin Klassen.
Thank you very much. Thank you very much, Albert, for this introduction. I hope you can hear and see me well. It's a pleasure to be, although virtually, with you and to talk about this topic. Um, I've worked on many financial crises. I hope we don't have to face one going forward, but there are these risks, and it's very good to see that you're getting ready in many ways, including by developing this online platform for non-performing loans. So I like to just give you a perspective. I will focus a lot on the non-performing loan side because that's the topic of your conference. So refrain a little bit from overall financial stability. There are many issues we can discuss in terms of what the state of the financial system is. If I were to do it in a short summary, I would say that in many ways we've been benefiting a lot from the reforms that we have had over the last 15 years following the global financial crisis. As a consequence, we have a much stronger banking system globally. There's always exceptions, of course, but on the whole, I would say our banking systems are much more better capitalized, much more liquid. As a consequence, they could sustain, as we have seen, major shocks during the COVID, and even more recently with the invasion of the Ukraine, where we had commodity prices increasing quite significantly, and all kind of recession risk looming. But nevertheless, we've seen the banking system cope very well with all these shocks. That doesn't mean that they're not going to be affected to some degree what we're going to see going forward. So in that sense, it's important to get ready. There are risks outside the banking systems, and that's something that we have to all watch more carefully and think about hard, how we can deal with risks in the non-banks. Because as we have seen already to some extent, I'm using Archegos here as a case in point, where a lot of the liabilities have been incurred by non-banks, they do affect sometimes the banking system as well. And that was a case of a very special nature, the Archegos. But I think we're going to see, particularly as we have the recessions coming in some countries, some parts of the world. But in addition to that, as interest rates rise more generally, we're going to find some of these non-banks having positions that are a little bit more extended than they thought. This is the phrase that has been introduced by Warren Buffett. We're going to find out those that have been swimming naked, so to speak, as to how exposed they are. And so as part of this going forward, this analysis, we should look at the non-banks very carefully as well. But let me, beyond the overall financial stability perspective, maybe I'll move to the specific presentation that I made, which is focused very much on the non-performing loans. So let me take you through that part of it. This is, as everything that I say, there's not views necessarily of me or the BI. There are of me, but not of the BIS. So your team developing an online non-performing loan trading platform. I think this is, as I said, a very important one. So I applaud you for doing this ahead of potential risks. And as COVID and other crises have shown, it's important to monitor and manage the NPLs ahead of the curve. And to some extent, financial distress can be anticipated. It's not that we can necessarily predict crisis very well, but the stress that comes along with crisis can be anticipated. And that allows us to intervene better and earlier. So we can take that to the current situation, for that matter, where we have a lot of energy shocks coming around the world. With better data and better monitoring, we can give support to those that need it really. That includes, of course, the firms, but also the households, for that matter. But then we could also set up better resolution mechanisms. Now, one would say then, well, what did we do during COVID? Well, COVID was a very special case in some sense. We had large shock globally, of course, affecting many parts of the real economy. And as a consequence, we were willing to give large fiscal, but also monetary support. And we've seen very low NPLs during that period. So in that sense, COVID is kind of hard to generalize as to what we will see going forward when we have new shocks happening that are not of that nature. And hopefully we won't have the same shocks occurring again. So this energy shock, for example, that we're going to go through in the coming months, year, will probably hit us more selectively, and this is where the data would help us target that support. So what's in the offering? High interest rates that we are observing globally, and most countries, there are some exceptions for domestic and other reasons, have not yet raised interest rates, but most of them are in that situation because they need to control inflation. That will lead to an expected global slowdown. We want that slowdown to some extent. We need the economy to rebalance in terms of demand. At that point, of course, will see some increase in NPLs. There's no doubt about that, that we're going to go up from the levels that have been historically very, very low over the past decade, including what I said, the COVID experience. But we shouldn't expect that to repeat itself. Partly because the shock is more targeted in certain sectors, but also because fiscal headroom is simply less. You cannot expect losses to be covered as much by the FIS this time around. The popular support won't be for that to the same degree. So it's more important even to get ready for those NPLs. In that context, an training platform will help a lot. I would almost say it's not only through exactly the training itself, but and as Albert mentioned before, it's really that you develop some greater transparency, more standardization, and that alone can ease the trading of NPLs, even if it's not through the platform per se. And more generally, if you were to have this platform in place, I can see a lot more diversification happening, not just after the NPLs occur, but even beforehand, as you have more standardization of loans and loan contracts and more information, you can attract a wider pool of investors, and in that sense, diversify the risk, and even maybe prevent some of the NPLs to the extent that they're caused by some lenders pulling out. By a more diversified pool, I think you can avoid the liquidity risks that sometimes occur becoming insolvency risks. So I think there's a lot to be said for that transparency and these that you can introduce through the training platform. But it's important, nevertheless, to reflect a little bit, and that's what I will really do in my brief talk with you, on the concepts of NPLs, and in that sense also build on existing and new data, so that when you introduce the platform, you kind of reflect on those as well. So let me give you first a little bit of why it's important to try to explain and predict NPLs. And joined with some work of colleagues here at the BAS who previously did this at the IMF, Christian Smeeder. He documented at that time already how much there is a common behavior of credit losses around crisis. So you see on the left-hand side, the difference between advanced and emerging markets exist in terms of the overall size of losses. When you look at what is a crisis in advanced countries, it's 5% of credit losses in extreme cases, the severe crisis, but that rises to about triple that in the emerging markets, where it can be 16-17% of GDP in losses during that period. Sorry, as a percent of credit. So of course, we're not expecting a severe crisis, but nevertheless, the NPLs ratio should be expected to rise in this period as we go forward with a recession. Now, one then should ask the question, well, can we anticipate that to some extent? Well, yes, there are some measures that we can think of. And the three that are the most obvious ones are the actual default rates on bonds. Bonds tend to have a little bit more of a transparency, so you can think of that as a leading indicator on the NPLs in the overall financial system. And you see historically that there's a little bit of anticipation in that sense, back to the GFC in 2008, 2009, more recent as well, where the NPLs from the bond rates were expected to default, and they did default to a greater degree. Two other indicators are more of a macro implied probability of default. If you were to run kind of a model, if you wish, for what you then expect the probability of defaults to be, they closely match in some sense because they're calibrated in the same way to these market implied probability of default. So both the green and and blue line follow each other very closely. They're a little bit of a lagging in that sense relative to the actual to the other rates, but they're close nevertheless. That the green, the red line, a little bit less so, but the macro one is definitely much better than the other rates. So you can get some information out of that, but it's not definitely not a perfect match to what the actual rates are. Now, why is this actually an issue? Well, this comes back to what do we define non-NPLs by? And so here's important, including as you go through the development, the further development of the trading platform, to think about these three concepts of default. One is purely the economic concept, failure of the borrower to pay back. That's what we would really like to see, of course. That's a non-performing loan. But then that doesn't always match in our existing data. And the data that we do have are more the regulatory concept and accounting concepts. So let me expand a little bit on those two, although you probably know them very well. The regulatory part of it is really focused on default and the probability of default. So that's asking the question, for example, in the banking rules on the Basel III and earlier, the default concept is based on whether you do not pay within 90 days for the retail, for the wholesale side, and 180 days for retail and public borrowers, or in other circumstances that the borrower is unlikely to pay. So it's really a probability of default concept and applied in a sense of, well, you didn't pay for the last 90 days, so you're more likely to default eventually. That is still looking at the 1 year horizon, because that's the banking rules look at that in most cases in terms of determining the risk rates for various types of assets. And then the third concept is the accounting concept. That is a little bit more about the actual impairment. So you can call it the loss given default, the actual default when the probability has gone to 1, you are impaired the loan, and then you have to, on the basis of the exact losses, the loss given default, if so to speak, whether it's on the IAS, on the US GAAP, you have to then incur that loss and put it in your loss and income statements. Now that's being replaced by the expected loss concept under a new IFRS and the European equivalent of that in many jurisdictions, where it's a much more of a forward-looking one. The other ones were, as I said, really backward-looking. As we go forward-looking, we're going to see quite a bit of changes, and it may even become a little bit more pro-cyclical in that sense that banks will start to provision before the losses actually occur. Which may mean that they will start to tighten, maybe at the wrong point in time, in some sense exacerbate some of the shocks that we may be observing going forward. This is still being rolled out and introduced, so we're only going to have to experience that in the next few years as to how these new concepts will play out. But nevertheless, let's give you three types of NPL concepts that we have to all think of it as being important. Because both from regulatory perspective, they determine interventions, accounting, they determine profits and losses. But in the end, of course, we are after the economic concepts. Now, that doesn't make it easier to measure NPLs. This is a complex, and I'm here really talking about here NPLs at the system or jurisdiction, the country level.
Catch that.
What is the overall level of NPLs? That it may not be easily available typically, and it's definitely most of the time backward looking. So in that sense, it's not that useful for making decisions today if you were to speak about managing a banking system. But there are some helpful concepts. So if you know, take the perspective of what we can do going forward, which countries would be more at risk, which systems, which banks, we can think of the three things that exist. One is the forward-looking on the basis of the market-based probability of defaults. Some of that is also in Basel III because banks are required to report on some of these data. And then, as I mentioned, the ongoing forward-looking incurred loss method that is being rolled out at the moment. You can do some nowcasting, so really looking at the NPLs more from a statistical perspective. what are the impairments now today, what are the realized losses, but we can try to improve on that with the other data. And then there's, of course, there's the backward-looking part. Now, it's the order of preference, as I wrote them, is already obvious. Forward-looking and nowcasting is preferred over any backward-looking concept, but of course they come with difficulties, so we shouldn't ignore the NPLs. They remain a common concept. And again, keep in mind there's a difference between the PDs, the probability of default, which is sometimes the more forward-looking part, and the loss given default, which is more the backward-looking part, where you actually get the NPLs and the NPLs stocks. So now, you want to talk a little bit about what we know of these data and how they exist and how you could potentially use them to complement the trading platform. So the forward and nowcasting sources, some of them are available. So Pillar 3, which is what the banks have to disclose in terms of their own NPLs, which is at least not backward looking, but at least a live update as much as you can. They're not available, of course, in a single data set. They're scattered by individual banks that disclose them. They do that on a quarterly basis. Some of them are reporting late, some earlier, and the comparability is not always there. So that's one thing that can actually be quite corrected. I'm going to give you an example then later of how that's being done at the moment. Secondly, vendor data, they're expensive, and so again, you would have to rely on an expensive source. They're mostly for listed companies, so they're not generally available either. And then we have the IMF that publishes the data from NPLs by country. You probably know those, the IMF Financial Soundness Indicators. We've been wrong for a long time, so that we have a long series on those. But at the same time, the lags are significant, as they do have to rely on the reporting of the individual countries and then the cross-checking that comes along with that. So the question is whether you can do better, particularly when there's a pandemic or any other shock that we experience. And here I think there are a few things that can be done. And let me just here quote some work that we have been doing at the BIS over the last year or so, where we have, particularly in the context of the COVID crisis, tried to project credit losses during the pandemic. So I'm citing here a number of papers. They take different perspectives as to how to come to this analysis. So there's a Banerjee paper that goes to individual loan by loan from a corporate sector perspective and try to come up with the total liquidity risk, and that can translate in terms of solvency risk. We also have looked at it from a sectoral perspective, taking sectoral allocation of credit across countries and seeing how sectors are exposed to certain shocks, and particularly the COVID shock was a specific one. So that has led us to some expected losses. There's been another work I'm mentioning just briefly. You can find the papers in more detail at our website. The last paper looks at the debt service ratio, which we've been using and finding quite effective, which is the amount of debt that's at risk from a higher interest rate, and how that translates then in terms of EBITDA, cash flow risks, and how that then translates into an NPL risk. Now, actually, all this work, as I mentioned already before, in some sense, showed that we overestimated the NPLs during the COVID period because it was such a special period. But nevertheless, I think the toolbox that's behind these papers can be applied, and we were doing it ourselves going forward as well. And what it does is all built on earlier work. I mean, the other relevant work, 2004 by Moody's, the work by Harvey and Smither, has developed some rules of thumb of estimating credit losses for a given economic shock in a particular country. What does it mean in terms of NPLs? The other important part, which we should keep in mind, is always the expected versus the unexpected losses. Now you would say, what's the difference? Well, in Basel terms, it's quite significant in the sense that the expected losses are covered by the provisioning rules, and that sense the risk weights as well in the banking book, whereas the unexpected losses should be covered by the capital of the bank for those unexpected events outside the normal distribution. And that is work that's in some sense is also predictable. Here, the debt service ratio can give you quite a good handle as well. There's another piece here I mentioned that you should think not only about the total amount of loss, but also the time it takes to resolve the loss. And this is work by Robert Asbach, who makes the point that the loss discovery period can vary quite a bit from a household vis-a-vis a corporate. So households may show up in 6 months or so, whereas a corporate loss from the probability of a recognizing to the charge of may take more than 2 years. So there's a difference here as well to keep in mind. Now I want to end up here with just something very specific in terms of some work that is on the way by the colleague of mine that I mentioned before, already, Christian Smeeder, with co-authors Lillian Chong and others at the AMRO research office that you probably all know. And together with them, we've been trying to put together some loss rates around the world in a more systematic way. Specifically, the objective is to make country-level credit loss theories available for as many countries as possible. And it wants to do that, and it's doing that for these 3 series types of data that I mentioned. So one, the forward-looking data. So looking at the market weighted average corporate PDs. So here really trying to extract from measures, and you know them, the various KMV measures, the Merton-based models of probability of defaults given the equity price volatility and the like, and then coming up with a GDP implied impairment rate at the country level. So that gives us an assessment historically, but also at the now level, in the sense of the current level of expected forward-looking data on losses. Then the nowcasting part of it is also there. So the realized rates by banks using the public information on the Pillar 3, collecting that as systematically as possible for all the banks that do list in the various jurisdictions. And then what I mentioned, the backward-looking part, the implied credit lossing from the actual NPLs, where the bank reports will be a little bit more timely than the IMF FSIs, but both of them are based on the same backward-looking concept. Now that data is being put together. It depends, of course, on the country at hand, how much data you can get, how many banks are listed, what is the ability to extract data from market-based corporate PDs and the like. So you're going to get some variation here, but the data is not always available as systematically as you might hope. So the backward-looking data is available much better, of course, going forward than the forward-looking data. Now that set of data is being put together in a website. So I'm doing a little bit of advertising here for those 2 people, the people you will see later in the year. So please be tuned, and otherwise send an email, and I can tell you where to find it at the AMRO and at probably at the BS website where you can find those data. And just to illustrate and whet your appetite a little bit, this is what's been put together for market loss implied loss ratios. Sorry, for 3 Asian countries: China, Indonesia, and the Philippines. On the left-hand side, you see historically decline. I think as systems have improved, these loss ratios have declined, but there's an uptake in some countries in China now more recently. The GFC also, of course, shows up in the earlier period. And then for the Philippines, you see an example of the various ratios that you can put together in terms of realized ratios, in terms of the implied ratios, in terms of the forward-looking ratios. So you see quite a difference here. There's a little bit more volatility in some of those ones, the implied ones. And there's a little bit more of a forward-looking component to some of them as well. But nevertheless, the GFC is also showing up here to some degree. So let me stop here and pass the floor, so to speak, back to the organizers for the next session. Of course, I'm happy to take questions, but I'm not sure that time will allow us. But thank you very much for giving me the opportunity to speak to you this afternoon.
And we will now move on the presentation of the publication on roadmap for the developing an online platform to trade non-performing loans in the Asia and the Pacific. And this report examines the feasibility of the establishing the electronic marketplace for the NPLs, and also explains how this would benefit financial stability in the region. And our lead speakers for this session, for two people, two authors of the book. First, Mr. Peter Lorenkranz, the financial sector specialist at the East Asia Department of ADB. And he supports and leads the lending project and guarantees and technical assistance, especially in the PRC, Mongolia. And his knowledge work focuses on the financial development and stability within the context of the regional financial integration and cooperation in Asia. Prior to joining the ADB, he worked at the European Central Bank and holds a PhD in economics from the University of Zurich, Switzerland. And Peter?
All right, so wonderful good afternoon to everybody. And thank you so much for the warm introduction. It's really a great pleasure to be here today and have the opportunity to present the findings of the report together with Richard. It's also really wonderful to see so many familiar faces again, especially from the IPAF members. So, and you know, there was a pandemic in between. We had a lot of virtual sessions, but I do recall the wonderful moments also together. For example, 2019 in Seoul, I think it was the last time we had the chance to see each other. So welcome, and so good to see all of you again. All right, so as a brief outlook for today's presentation, so I'll be pleased to share a bit on the background and the context of the study. And then Richard will be going into detail on the practical considerations of establishing an online trading platform that we identified in the course of the preparations of this report. And I'll be concluding with the key findings of the report. So as we all know, previous crisis experience have already illustrated negative and persistent macro-financial effects that NPLs can have, including on the real economy, that really underlines and underpins the importance of swift NPL resolution measures. We also know that in current times are quite volatile. So we just are basically departing from the COVID-19 pandemic. There's the Russian invasion of the Ukraine, monetary tapering, increasing interest rates globally, all of which then obviously can feed into stress on credit quality and ultimately could result in an increase in NPLs, which we haven't seen yet so far. That was also nicely explained in the previous keynote speech. Due to several reasons, we didn't see this large pickup in NPLs yet, but there's certainly a risk that we see in NPLs rising in this year and beyond. Therefore, developed market value trading can be really, really important to ultimately contribute toward a swift and effective NPL resolution, and hence also sustained recovery from the COVID-19 pandemic and turbulent times we are facing today. So actually the relevance of developing NPL markets, strengthening NPL resolution mechanisms, but also considering an NPL trading platform is not that new, but the current time really makes it even more timely. So it really probably the relevance lifted, and it underscores the relevance of such such measures that would even allow for a swifter NPL resolution, including in the Asia-Pacific region. And against this backdrop, this report really seeks to examine the feasibility of establishing such a trading platform, including also looking at specific countries' readiness. Just a few things on the background of the report. Some of the origins lay in the thank you, in the IPAF CCM and the Coordination Council meeting in 2019, where it was brought up, sort of the idea was brought up to consider such a feasibility study of establishing an NPL trading platform. And ADB was very pleased to prepare such a feasibility study with the assistance of a number of different parties, including Deloitte, for example. Richard will be very pleased to present together with me today the findings of the report. but also really benefited greatly from IPAF members. Thank you so much. We really had interviews, in-depth interviews, surveys, without which this report would not have been possible to be prepared. Additional insightful consultations were done with various stakeholders, including, for example, the Joint Vienna Institute, but also EBA, where we learn a lot on the European experience, for example, on the EU's action plan to reduce NPLs, but also progress in Europe on developing NPL data templates. So brief context here is on the current NPL levels and ratios in Asia. I'm sure you're well aware of these, but still to set a bit the stage. So we do see that there are some considerable increases already if you compare within COVID 2021 and 2020. But again, we may expect even further increases. For example, Moody's, among others, they forecasted really NPLs to double in the Asia Pacific region by the end of 2022. Of course, that needs to be seen, but there are certainly risks that this can increase. This, well, once it gets back on the screen, so this map also provides some overview of those countries that have been looked into a greater detail in the study, in particular Republic of Korea, Indonesia, PRC, Thailand, and also Kazakhstan. To add a bit to the overall context of challenges to NPL market development in the region, here's a brief table on time and cost of resolving insolvency in Asian economies. And here we really do see that there are considerable differences across countries. So there are some countries in which the time of recovery and of resolving insolvency is rather fast, with the high recovery rate and low cost of recovery, whereas there are other countries where it's rather considerable, 5 or more years. Obviously, this drags on demand for NPLs and hence potentially also prevents NPL markets from developing swiftly. And this chart, we can think of it as a sort of a synthetic estimated bid-ask spread or estimated bid-ask spread in Asia Pacific, which shows basically the difference between the net book value and an estimated bid price. And these are based on cost of recovery and also time of recovery and respective bank lending rates and investors' rate of returns. And here, basically what they should picture here is that there is probably a very significant bid-ask spread at play in the Asia Pacific regions, and many ways through which one can reduce it would be quite helpful. One of which could be, for example, the establishment of an NPL trading platform that can help reduce information asymmetries, can help speed up specific processes, and hence reduce this estimated bid-ask spread. So before I'm handing over to Richard, just going through a few features of underdeveloped secondary NPL markets. So on the one hand, of course, one feature is the limited numbers of active investors. Again, this can be a result of entry barriers, that can be a result of high due diligence costs. It cannot just be a result of not really a willingness to buy or to sell. So, and that, again, an NPL trading platform can facilitate and can actually attract and provide a platform for attracting more investors. High bid-ask spreads, we talked already about it before, that can be addressed also through more quality data, both so that the investors are better informed and can make better decisions in order to bid for such an NPL. There's also one of the features, predominantly domestic market. That of course depends on the country and the country size. So, but it's probably more important for smaller countries to also think and consider opening the market for foreign investors, simply to have a bit have more investors and more ultimately better functioning NPL markets. Perhaps all these aspects or features of undeveloped secondary NPL markets can be addressed by such a trading platform. And I will now be most pleased to hand over to Richard, who will go in more detail through the practical considerations that we identified in the report of that NPL trading platform. And Richard, I'll be pleased to control the slides. Just give me a heads up.
Thank you very much. Thank you very much, Peter. And welcome everyone. It's a pleasure to be with you. I'm sorry not to be with you in person. Unfortunately, other stuff in the UK have prevented me from doing that. But I hope that you've been having an enjoyable and very interesting series of meetings and discussions. Just a little bit about myself. So I'm a director at Deloitte. I've been with Deloitte for 38 years, 30 of those years in terms of restructuring and insolvency. I sit as part of our Portfolio Lead Advisory Services team, which is a global team advising on deleveraging and loan portfolio transactions. And since the start of the global financial crisis, we've been involved in transactions of around about 600 billion since the start of that period across every major asset class and jurisdiction. And so it's been very interesting working with Peter on this and with colleagues, and very insightful. So what I think I'd like to do is just very briefly go through some of the issues that we considered when we were looking at this. Peter's already touched upon some of the features of underdeveloped markets. But when we started in terms of this project, we looked at, well, what will investors really be looking for? And we identified possibly 6, and clearly there may be more, areas that are of key importance to investors when they start to consider getting involved in a market. And those are set out on this slide here. Buyers and sellers need, first of all, a degree of certainty, or at least good understanding of the regulatory regime in terms of what's permitted when buying or selling NPLs, what additional requirements may be needed. Clear and supportive frameworks for transfer and investment are crucial to developing an efficient market. But some markets in Asia still lack clear policy guidance around resolution methods and loan sales. And typical issues can include things like restrictions on types of loan which can be traded, collateral ownership and enforcement, licensing requirements, and that sort of thing. From a legal and regulatory perspective, and this was in part illustrated on one of Peter's earlier slides, the Asian region is very fragmented. So in some jurisdictions, we see regulators taking a very strict and hands-on approach with regards to sales or transfers, with a focus on who the transferees and investors in such transactions, along with consumer protection and customer complaint issues, and that's quite right. Elsewhere, we've seen a relatively hands-off approach, limited written guidance with no specific regulations in relation to the sales and management of NPLs. There have been a lot of developments over the years. So in the PRC, we've noted that CBIRC acting in a very pragmatic and sophisticated manner, and it's first and foremost focused on regulations, procedures, and will periodically release guidance on this. So that's helpful. Considering the legal framework, Peter's already touched on this, investors will be looking for a creditor-friendly legal regime for restructuring and enforcing the contracts. We've seen very significant differences between how long it takes to resolve NPLs in different countries, and that's obviously an issue, potentially slowing the development of the market down in some countries. So, you know, in the PRC, I think we saw periods of between 18 and 42 months, depending on the status of the security, location of the assets. Republic of Korea and Thailand are considered to have relatively established legal frameworks for NPL resolutions. In other countries, we've seen periods of up to 5 years to deal with cases. But I think it's appropriate to recognize that governments are taking steps to address this. Another key area is the depth and experience of servicing and restructuring skills. This is a key driver for recovery for investors, and having sufficient servicing capabilities is essential to rehabilitate debtors. What we've seen else in some countries is foreign investors teaming up with experienced local services, or alternatively arrangements whereby selling banks will retain ongoing servicing, albeit obviously that has some drawbacks because it doesn't completely allow the full deleveraging from the bank's perspective, operationally that is. I think, and I think Steen mentioned this also, you know, having active participation in foreign investors in domestic NPL markets is very beneficial in terms of opening up access to larger capital pools, which can absorb increased levels of debt. But as I said, those uncertainties are potentially barriers to the further development. From a seller's perspective, I think, you know, it's important that sellers commit to the process and recognize the importance of accepting realistic pricing. A reluctance to accept losses, restrictions on abilities to sell below par will inevitably discourage NPL transactions. In terms of transaction activities, you know, what are we seeing? For, you know, the PRC, it's the leading market in the in Asia. The NPL volumes traded is on a par with some of the busiest markets in Europe, and NPL investors are becoming increasingly interested in that, but albeit with a sort of degree of caution around sort of market uncertainty, reflecting the unfamiliar legal environment. Republic of Korea and Thailand have well-established international investors, but perhaps less active in recent years, reflecting relatively stable NPL levels, albeit of course that with the pandemic and the ongoing high inflationary environment, high interest levels, which central banks are rolling out, we may well see an uptick in interest in that market. So what we sought to do here is just to show, for illustrative purposes, what the NPL transaction process looks like, because this then becomes relevant when it comes to the deal platform that we're talking about. So essentially what we're seeing is 3 different areas at 4 separate stages. So planning, a preparation, and an execution and closing stage, some of which will be internal to the seller, some which will be sort of one-to-ones between buyer and seller, and some potentially visible to the market as a whole. And this includes, you know, information set up on the virtual data room, notification to buyers of a process starting, signing of non-disclosure agreements, due diligence, which can be partly public and partly through sort of closed data rooms, bidding, offer evaluation, signing and completion. Some of these are already done on an online basis. Others are still mostly offline. What we sought to do here is just illustrate how transaction platforms commonly are operating within the Asia context. And this is based on the Taobao platform, but others have very similar sort of concepts. It's a 6-stage process: public notification of the auction, offline due diligence, bidders paying a security deposit to participate, submission of the bids, confirmation of the winning bidder, and completion. At the moment, a lot of this is done offline, with only sort of the notification and the auction stage being done online. So what might a full online process look like? So here we've set out what a full online process might look like. going from sort of transaction facilitation, review and validation of the data, data warehousing, and ancillary services. Essentially, what the platform seeks to do is to become a complete online marketplace, allowing buyers and sellers to connect, to view portfolios for sale, to conduct due diligence, to and also for the intermediation of ancillary services for value accretive services. I think some areas just to pull out: data review and validation is a key concept, key part of this in order to build confidence in the platform. So there would be a level of checks and balances to ensure good quality data. That doesn't remove the need for individual bidder due diligence, but it's to ensure that there's a consistency of good quality, timely information on the platform. Data warehousing, and this can take a number of different forms, but essentially this is a full virtual data room, allowing access to selected parties. So there would clearly be the need for non-disclosure agreements still, but the platform would offer standardized versions of those to speed up the process. Due diligence through the VDR, but it can also be used, and this is a slightly longer term benefit, and can also be used as essentially as a source for a central data repository, which can provide good quality template level information for policymakers and regulators, etc., on the evolution of MPLs across the market across a period of time. That's a slightly longer term objective, but still one that could be achieved through the platform. Essentially, what this looks to do is create more visible meta quality portfolio information to improve pricing, reduce bid-ask spreads, and to allow faster resolution or transactions of non-performing loan portfolios. So what are some of the practical issues that we looked at in the report? And I'm not going to cover all of these because I know in particular we've got colleagues from the EBA who are going to talk a little bit about some of this, and it'll be interesting to get their perspectives, and also from other panelists in the subsequent session around their practical experience. A couple of areas perhaps to pull out. So first of all, thinking about the ownership of the platform and its governance, I think potentially 5 different concepts that could be explored: state ownership, private, public-private partnership with AMCs or with international development organizations. Each have their own sort of pros and cons. In terms of just going from left to right, state ownership as enablers, government involvement will be important particularly in the early stages of development, including in terms of potential enhancements which are required to the legal or regulatory framework. And as we talk about in the report, and as has been highlighted elsewhere, countries are at different levels of readiness for such a development. But of course, there are potential downsides to state involvement, including political interference. Private operators bring with them a significant experience. However, as first movers, they may hesitate at the amount of work required until the concept has been proved in the relevant jurisdiction to make it a viable commercial proposition. So this is a sort of first mover disadvantage. AMCs, many countries, AMCs are already significant holders of MPLs. They have in a number of cases their own platforms which could be essentially rolled out and expanded to cover third-party transactions as well. Although, objectively, I suppose some might have concerns around that. And again, then there's, roles for international development organizations as essentially, priming the pumps and giving expertise on this. We had our own views and a number of different views, but I think what we, our conclusion is that there would be different levels of involvement of all of these organizations throughout the development of the process, potentially with greater state involvement towards the start, but then moving more towards a sort of private model thereafter. In terms of the another area that we considered was what should be the asset focus of the platform, considering that one of the key benefits, key objectives of the platform is to drive reduce costs. The broader the focus, essentially the bigger, the better the opportunity in terms of creating economies of scale. So, secured and unsecured loans could all potentially be transacted on the platforms. Secured loans are relatively easier to roll out. The documentation is generally well available. The requirements are well understood. And it's easier to value collateralized NPLs than unsecured ones, albeit it may be that in early stages, unsecured loans become the first to be transacted as banks seek to deleverage. Retail portfolios benefit from a homogeneity of underlying products and borrowers. Loan files are usually standardized with limited customization. So again, there's an area there. NPL platforms broadly look to benefit from realizing economies of scale, and as such, benefit may be achieved by considering a broader range, albeit recognizing that initially the focus may start in particular areas. We also considered the balance between regional and national platforms or domestic platforms. Of course, there are benefits from regional platforms, including diversification on a cross-border basis, but equally, one needs to recognize different jurisdictional requirements, which creates challenges there. So it may be that domestic platforms are the ones to start off first of all. And I think finally, what we wanted to perhaps touch on, and this would be interesting to get other panelists and participants' views on this in terms of whether the platform should be mandatory to use. It's a little bit of an area of debate, but I think clearly there's a benefit in all parties using a platform such as this. There may be incentives which are needed in order to encourage investors to use it. Those benefits are important in terms of bringing down the costs of use of the platform, and so some level of subsidy for the platform may be necessary in initial stages, just whilst the concept is essentially being proved. We also considered whether some sort of tax incentivization might be used in terms of the level of good level of information that such platforms might allow, but that needs obviously to be balanced off by risks around moral hazard. However, I think that's probably a manageable issue. So I think this is probably an area which is still up for debate, but one which I think could be and should be explored in further stages of the study. So Peter, I'm going to hand back to you and look forward to taking questions in the panel session.
Thank you so much, Richard. Let me conclude with the two final slides on the key findings of the report. Of course, one of the interesting and important question is who and what next, and which for example, countries or markets would be in the position to actually kickstart such a development of a regional or domestic and or regional NPL trading platform. So as part of the report, we did, well, more or less a back of the envelope comparison and calculation on a country's readiness for an online NPL transaction platform. We did compare absolute and relative NPL levels. Obviously, absolute numbers, more NPLs there are, the more market potential there is, including for an online trading platform. Also relative levels, we gave some sort of weight, the experience of NPL trading and or if there was already some NPL trading platform operating, as well as ultimately also the strength of the legal frameworks, which of course these all go hand in hand. So a platform can only work well if there's also the necessary legal framework. And based on that, again, rather simple computations and the countries that we looked at in more detail, we found that the PRC, Thailand and Republic of Korea and Indonesia could have a good readiness for such a trading platform and could benefit the most from such an initiative. And we also note that in the course of our discussions and during the study preparations, that both Kazakhstan and Vietnam governments are actively actually exploring the development of an online trading platform. So in terms of the final slide, let us leave you with a few key principles for development of NPL markets and an online trading platform. So first, harmonization is important. Adoption of agreed international standards for NPL recognition and evaluation methodologies. For example, many countries in the Asian region have adopted IFRS, or in particular IFRS 9 financial instruments, not all. Of course, this could be one way to have it sort of harmonized across countries. If those were all to participate in such a platform, that would make things a lot easier. Second, level playing field. NPL markets and platforms should be regulated on non-discriminatory basis. Obviously, regulation needs to be in place. At the same time, there should not be any discrimination between foreign and domestic investors, so same rules apply for all. Level of minimum standards should also be developed both in terms of NPL markets generally, but also for the online platforms. Consumer protection, again, should be put in place. At the same time, should not restrict lenders' ability ultimately to work out NPLs efficiently. So some balance should also be put in place here. We found that, I mean, not as a surprise, that NPL markets and ecosystems in the Asia-Pacific region are heterogeneous, at different stage of readiness. And as such, the development, if you think about a regional platform, could be attempted in a phased approach. So obviously important to be ambitious, but at the same time, perhaps it's not doable to have all countries trading all their NPLs at the initial stage in such a platform. So a well-sequenced approach probably is the way to go. And one of the options that also came out is either one or even a network of platforms that could be an option with which have common standards, for example, with the data template or other standards, but they would be linked and cooperate with each other to ultimately maximize the reach and number of transactions across borders, but be at the same time still individual platforms. All right, let us thank you so much for your attention, and we very much look forward to questions and further discussion. Thank you very much.
Thank you for good presentation, Richard and Peter. And now we were gonna, it's time for the moderated panel discussion on this issue. And Mr. Jong-woo Kang, the principal economist at the Economic Research and Regional Cooperation Department of the ADB, will moderate the discussion. And Jong-woo is a seasoned economist with extensive knowledge and experience on policy and strategic issue. He was senior advisor to the Managing Director General of ADB and senior economist at Strategy and Policy Department of ADB. He leads the annual publication of Asian Economic Integration Reports. And before joining ADB, he was director at Ministry of Finance and Economy of Republic of Korea. He got his PhD in economics from University of Washington. Jong-woo will introduce the panelists and moderate the discussion afterwards. Jong-woo, floor is yours.
Okay, so thank you very much, In-young, for your very kind introduction and taking sufficient time to introduce myself to the audience. So after listening to the very interesting keynote presentation by Dr. Stein, followed by another keynote presentation on the newly launched report by ADB, by Peter and Richard, I think that we are prepared to have some interactive and interesting discussions among the esteemed panelists who are joining us today, this afternoon. So let me briefly introduce each and every panelist joining us today. We have the Mr. Oleg Shmeljov from the European Banking Association. He's the team leader in the reporting and transparency unit, primarily involved in the topics of non-performing loans and credit origination, and leads the EBA-wide policy work on the non-performing loans. And he will be joined by another colleague from the EBA, whose name is Ms. Lija Shibao, and she's the policy expert in reporting and the transparency unit, and who is primarily involved in the topics of non-performing loans and supervised reporting on financial information. And she's also taking responsibilities on Pillar 3, disclosures, including topics like ESG, the hottest topic in the world at the moment, and the risks and the sustainability related disclosures. And then our next panelist coming from the International Finance Corporation, IFC, he's Ms. Mahima Khanna, who is a seasoned economist, strategist, and investment professional with more than 10 years of experience in financial sector development in emerging markets, and currently working in International Finance Corporation's Financial Institutions Group as a global upstream officer, leading first of its kind investment platforms related to post-COVID Building Back Greener, and the facilities for financial institutions and other platforms related to housing finance, distressed assets, and the clean energy finance and SME finance. And we are also very pleased to be joined by another expert from the World Bank Group, whose name is Mr. Kalis Bauze. He's a senior financial sector expert at the FinCET, specializing in non-performing loans again. And prior to joining the World Bank Group in 2016, he was a policy analyst at the European Commission in Athens, Greece, and was an EC representative at the Hellenic Financial Stability Fund, and actively participated in the work of the EC financial team. And last but not least, sitting next to me is Mr. Bukhar Hepe, and he's the Chief Technology Officer and NPL of the NPL Market Limited, and he has 13 years of experience in international investment banking and 20 years as an entrepreneur. In 2018, he co-founded NPL Market Limited in London, an innovative loan marketplace and analytics platform. As CTO of NPL Markets, he's responsible for the development of loan valuation, credit portfolio management, and securitization reporting solutions. Okay, with that, I understand each panelist will, during this first round of the intervention, will share their own insights and views on what are the major issues and major lessons learned from their own expertise areas, and then in the context of how those lessons could be helpful for the thinking about how to build a new regional online platform, NPL platform in Asia and the Pacific region. So I understand the panelists will have a couple of numbers of slides as a visual aid, and then I will go first to Mr. Oleg and Lija from EBA. So you have the floor, Mr. Oleg and Lija.
Thank you very much for this kind introduction, and good afternoon, colleagues, and well, good morning from Paris. I'll share my slides with me in a second. Right. So the intention of this intervention will be just to explain and share the experience what we have been doing at the EBA. The focus of the EBA has been quite narrow on the standardization of the data, and that's where we will spend a little bit more time. But first, to give you some overview of what we have been doing in the European Union and similarities of our thinking regarding the establishment of the online trading NPL platforms to what we have just heard from the Richard and Peter's presentation. But well, the Europe has been subject to the global financial crisis, and then we had the sovereign debt crisis further on in Europe, and then we were looking at the common approach to dealing with the issue of the non-performing loans and the resolution of the non-performing loans. And we were facing many similar challenges, as we heard the Asian region is facing in terms of the differences in approaches, differences in the definitions. Well, frankly, when we entered into the global financial crisis and the sovereign debt crisis, we haven't even have the common definition of non-performing loans. So we had to work that one first in order to measure the problem and understand the problem. So in a way, the response has been a bit slow and a bit delayed because, well, the European Union is a collection of the countries. Some aspects of this, of what we are doing is harmonized, something is less harmonized. We still have the national interest, and it's quite a difficult task to agree and to harmonize everything. But we get it going with the resolution of non-performing loans with the comprehensive European Council action plan in July 2017. So you can see that it actually taken a bit of time after the peak of the crisis. First, we come up with a definition of the non-performing loans, the common definition, which later on became also the global definition. So that was back in 2014, but we had a comprehensive action plan only in 2017. But the beauty of this plan was that it was all encompassing. The plan had 13 different mandates across the EU, legislative mandates, policy mandates, practical mandates, looking at the harmonization of the NPL resolution, at the data standardization and improving of the workout frameworks. And there have been 3 specific tasks linked to the NPL platform. First is the proving of the loan data tape information. So the data infrastructure which the banks have. And then we had this 2 second tasks related to the NPL markets, this development of the secondary markets or boosting the development because the markets existed, but they needed a bit of the kickstart. And we've been also looking at the NPL data infrastructure and the NPL data transaction platform. So this resulted in 2 specific deliveries. So this resulted in 2 specific deliverables, which we have delivered. 2017, we had first EBA transaction platforms, which was the voluntary platforms at that time. And that was the start of our work on the data standardization for the sales of the NPLs. And then we had a comprehensive Commission working document, which outlined the European view on the future of the transaction platform. So more or less the similar type of thinking which Richard and Peter presented for your region, we have been trying to identify what could be done with a view of establishing EU-wide transaction platform. So we have completely disparity in terms of the situation with the non-performing loans in the countries. We have here on the slide, you have the average NPL ratio for the European Union. But at the same time, we had countries who have been more severely hit with double-digit NPL ratios and where the resolution was needed. And I cannot say that the resolution was not happening. There have been sales, there have been quite massive disposals of the NPLs, but they were mostly done by the large banks or the groups of banks to the large investors. And we were looking into the way of kind of boosting this market, attracting smaller investors, attracting the smaller banks, and develop the thinking on the EU-wide transaction platform as an electronic marketplace, and been considering more or less the same issues which Richard and Peter have highlighted. So what sort of services the platform should be provided, whether it's just the data services or it's a trading venue, what sort of the data standardization, so how to reinforce the use of the NPL transaction platforms from the EBA, which came out at the same time, the governance, legal aspects, whether we need to have one single EU platform with some sort of the public sponsorship, if it was a public sponsorship, whether the money should come from the European Union funds or the national funds, and the incentive, the challenge of the incentive, which Richard has flagged, is how to make banks to use these platforms to dispose of the non-performing loans. We were thinking of some supervisory incentive, but this was not an issue. That was what the banks and investors were interested at that time, was mostly tax incentives, which were beyond the harmonization what the EU public authorities could offer at that time. So all of those thinking was kind of developed and put in place with the conclusion of more or less the same what we just heard. So we had already private platforms operating, and we should be continuing supporting them through better data standardization and through some sort of at the time we were thinking even of the seal of approval, so the common standards for the platforms. But honestly, we haven't moved anywhere further with that. Also because that the market actually works. So you see that we have been the NPL ratios in Europe have been declining. Banks have been disposing NPLs, working out NPLs. The economic climate at that time was also quite benign, supporting the sales of the NPLs. Some countries went for also this public supported NPL securitization programs to increase the sales and boost the sales of the NPLs. So in the end, we did not establish a European-wide platform. So all this thinking was left there kind of for the future work and the future reference. But we have highlighted for the European Union the points which will require further attention and further work. And one being the data standardization and data transparency around the NPLs, both pre-transactional and post-transactional data. And that's where we have continued our work since when. And I hand over to Lydia to walk you through what we've been doing.
Thank you, Oleg, and good afternoon to everybody. Yes, I will present the EBA work briefly. In particular, just to say that in response to the European Council action in July 2017, the EBA has developed the first version of the templates that was a voluntary version of the templates with the aim to facilitate the transactions in the secondary markets through a data standardization. Since the first publication of these templates, the EBA has been engaging with the stakeholders, and in order to understand the market uptake of the templates and also the current market practices. In terms of feedback that we received the feedback that the templates can be an effective tool to improve the granularity, comparability, and quality of the data, but they were considered too complex and maybe disproportionate in relation to the current market practices. So this called for a review of the templates, the first review in 2018, and the second review, it was in 2021, where we published a discussion paper in reply to a specific request by the Commission in its communication on tackling the non-performing exposure after the COVID-19 pandemic. And the discussion paper, together with the feedback that we received from the public consultation of this discussion paper, were the starting point for the current work. And we are now developing and implementing technical standards. So the templates will be mandatory, not anymore a voluntary version of the templates. And this draft ITS came from the mandate that the EBA received in the directive on credit services and credit purchasers. It is just an overview of what we have in the consultation paper. We are now working on the feedback that we received from the public consultation that was during the summer, and we are going to submit the final ITS to the Commission by the end of this year. So we have streamlined the templates in comparison with the previous version of the templates. And we have 5 templates with the key information regarding the counterparty of the loans, regarding the quality of the loan, and also the information in case of secured loans regarding the collateral. All this information are the information that are essential for a financial due diligence and for a loan valuation in order to start the sell or the transfer process between the buyers and the sellers. These templates are complemented by the related instructions and also a data glossary with the definition of the content of each of these data fields. In the previous version of in the voluntary version of the NPL templates, EBA NPL templates, we had more than 400 data fields. Now in the consultation paper, we have 157. So we have drastically reduced the number of data fields, and we have also differentiated between data fields that are mandatory and non-mandatory. So this is a very quick overview of our work, and in the final slide you can find also some useful links to the EBA website and the Commission papers. Thank you for your attention, and I'm looking forward to answering your questions.
Thank you very much, colleagues, also from my side.
Yeah, thank you, Oleg and Lisa both. Thank you very much for your quite interesting presentation, showcasing how the EU level, the data template has evolved over time, and going through the voluntary stage, going from the voluntary stage, moving on to the mandatory stage. So my question before we move on to the next speaker, so how many years has this the voluntary phase been operated, and then now you are moving to the mandatory stage? So I'm just I just wanted to in case Asia, if we try to introduce the new data platform and the data template in a phased manner, then how long the adjustment period will be required in terms of voluntary stage. So any quick feedback on this?
Well, we started with the templates back in 2017 and then reviewed them immediately in 2018. And since then, they've been there as a public good for anyone wishing to use and sell NPLs to use them. So we did not really enforce it. And there was no enforcement mechanism. So it was a public good from the EBA to deliver it for the use. I mean, we've been talking to some market participants, some been using them more or less, and Burkhard on the panel has been also using them, so he might share experience how they applied the voluntary version of the templates in their panel. But in terms of the years, well, it's from 2018 to 2022. So 2022 is when we are developing legal product, which will turn these templates into the mandatory use. And which will apply then in 2023. So 5 years, if I may say so.
It's interesting. So now we can have some more discussion after we have gone through all the first round of intervention by all the speakers. So let's now move on to next speaker from the IFC, Ms. Mahima Khanna. So you have the floor.
Thank you very much. Very good afternoon to everyone there in Manila. I'm very sorry I couldn't be there in person. But from my side, a very good morning from DC. I must say that typically economists tend to agree to disagree with each other. But just listening to Peter Richard's presentation and then the thoughts shared by Oleg and Lydia, I couldn't agree more. On this topic, I think it's one of the few topics where we all seem to be very aligned in what we are saying and also what we are thinking and trying to implement. So I want to start off by sharing with you guys a little bit about what IFC has done in this space and what is the approach we took. And I'll go very quickly because you've heard a lot of this already today. So back in 2020, just when COVID was starting, is when we thought that we need to take this topic very seriously and look analytically, because with COVID, NPLs were going to balloon, right? Before COVID itself, in some of the Asian economies, India, for instance, there was $150 billion of NPL. The numbers are sizable, or the shares were sizable in other markets. So that's really what got us started on this initiative back in 2020. And we looked at what has worked and hasn't worked in this space. So we did look very extensively in the European model, both from what EBA has done, but also what the private sectors and have been doing. So the likes of NPL markets were there in the room right now, and also our partners. What have they done successfully and not so successfully? And is there a way to replicate or take what's worked well in the developed world to more frontier, to more emerging markets? And so that was the genesis of our work. And we started that off with what we call internally as an upstream initiative, right? And so an upstream in the IFC speak, for those in the development finance world, is not a transaction. So it's not an active investment, but neither is it an advisory or a technical assistance. It's to be able to partner jointly with the public or private or both stakeholders, incubate, test a concept to see if it crosses the line and becomes investable, scalable in the near future. So that's really the way we took this model. We did do a very thorough legal and regulatory review in 4 markets which were of key interest to us. We narrowed down from a long list. The 2 in Asia we looked very deeply were Indonesia and India. And then we looked at 2 other markets in Latin America, Brazil and Mexico. And we looked at the legal environment for NPL resolution, for setting up of an online platform, for trading of portfolios, for data disclosures, legalities around the platform operator itself. And with that kind of information, we also looked at who are the players in this space. You have one in the room, very knowledgeable and very thorough in what they do, but there are other players as well, right? So we looked at all their different business models and tried to understand what could work where, and where is the interest also, because models can work, but you need to really have the same passion and interest from a partner to be able to try something new, which right after COVID or right during COVID is pretty challenging. And so with that, we then, I think about a year back is when we started having very serious conversations with NPL markets, with Burkhard, Gianluca and others in the team. And we signed a collaboration agreement to incubate their tried and tested model from Europe with our knowledge of these markets and network in these markets in both Brazil and Mexico. That is currently ongoing, but I can tell you my view of this whole initiative. There seems to be a lot of appetite from both banks and sellers, but also from buyers of portfolios. So we've been speaking jointly with a number of servicers, with a number of distressed asset investors who are very interested to know more about the space, see how they can tap into it, and not just continue relying on one-on-one bilateral discussions to buy portfolios across the whole segment, right? Whether that's single assets or smaller portfolios, there is appetite, there is interest. We've also found that it's not just the big banks who want to sell portfolios, but we're seeing a number of small, mid-size NBFIs, other non-traditional lenders who would also want to come to such a platform if it were to be set up. So all in all, work is still ongoing. I don't want to talk too quickly and too early, but I think it's going in the right direction. So the questions I was asked specifically was, can we learn from what we've done in Latin America in Asia? And second of all, what would the challenges be?
Yeah, Mahima, sorry, but perhaps I may have some intervention here. So we will have a more interactive discussions around those kind of questions later. So perhaps you can, if you can kindly wrap up your presentation, we can move on to.
Sure, that's fine. I can come back to this. I think if you're coming back to this topic later on, then I can answer it then.
Sure, thank you. Thank you very much, Mahima. So in the interest of time, so let's just move on to the next speaker from the World Bank groups. Khalis, you have the floor.
Good afternoon, everyone. And thank you very much for inviting me to participate in this very timely event. Let me pull up my presentation. So I think I agree with most of the previous speakers who were saying that online trading platforms would be a very valuable tool for resolving NPLs, either existing NPLs or potential in the future. And I think it is very valuable that a roadmap is created now for different authorities and different market participants to better understand what needs to be done in order to create this trading platform. I'll focus in my intervention on 2 points. The first point is I'll try to elaborate more on pros and cons of internal platforms and external platforms. And then I want to discuss a little bit as well on preconditions for building these online trading platforms. And let me start with the first pros and cons and how to decide whether to create internal platform or external platform, because we know that there are a number of external platforms available. These are global platforms, and therefore authorities or countries which are deciding whether to create internal platform within the country or regional platform or to go directly to existing platforms need to consider different aspects. The third thing what I would like to say is that it is feasible to create internal platform for countries where asset management companies are created or there is an envisaged that these asset management companies will be in place for long term, and there will be a long revolving pool of assets coming in, not only the stock of NPLs, which need to be resolved right now, but as well in the future that there will be a flow of assets. Otherwise, if the internal platform is created and there will be no future flow of NPLs envisaged, it might be quite a big investment initially, and it will not pay off in the long run. And it is important as well that there is a diversified pool of assets to be available for sale on these kind of trading platforms. It's not only retail loans or retail secured or unsecured, but as well corporates and SME loans, maybe not at the initial stage, but maybe in the future. And therefore, these aspects need to be considered. An important aspect when internal platforms against external platforms are considered is time to establish internal platform. External platforms are available right now in the market, so these are instantly available. However, if someone wants to create an internal platform, it will take a number of years to create them, test them, and afterwards to complement with different improvements. Obviously, it comes with the cost, and our experience show that creating these kind of platforms will be quite costly. And the examples show that this is about $2 or $3 million US. And obviously, if the asset side to be sold on these platforms is not high, then most probably it's not a viable investment. Another experience what we have from different countries is that developing countries usually lack experience in terms of experts who could build these systems, and therefore it might take additional time to identify these experts who are able to build these systems and afterwards to maintain them. And final point, which is very important as well, that large international investors quite often are familiar with existing international platforms. So they know how they are operating and what kind of data forms they have and how virtual data rooms are working. And therefore, it might be additional effort for them to switch to internal trading platforms. However, if there is profitable opportunities, of course, investors will be jumping on internal platforms as well, but it might take some time. Another aspect, what I wanted to discuss is on preconditions for establishing these platforms. We were working together with Vietnam Asset Management Company, and they requested the World Bank for our technical assistance on how NPL trading platforms have been set up all around the world. And we conducted a survey of asset management companies, both in Europe and in Asia. And we covered 8 asset management companies, which includes European asset management companies like NAMA, Sareb, Spanish asset management company, and the Ukrainian Deposit Guarantee Fund. And in Asia, we covered Comco, Indonesia, Thailand, and Japan. However, we didn't cover Chinese asset management companies because it was difficult to cover them. And the finding out of this survey was that only 2 out of these 8 surveyed asset management companies are currently using trading platforms. And these 2 are Comco and Ukrainian Deposit Guarantee Fund. The experience of them differs. First of all, Comco mostly use tangible assets for sale. So they sell real estate, land, other non-movable assets. However, Ukrainian Deposit Guarantee Fund sells both loans and tangible assets. So in a way, this shows that primary target for selling assets on these online platforms are tangible assets and maybe not so much loans, because often loans require more information, and particularly large loans might require specific fine-tuning and more due diligence. One of the findings was that initially these platforms were set up only for trading purposes. However, afterwards, these platforms can be turned into profit centers as well by providing additional brokerage services or additional services which could further improve trading experience or narrowing bid-ask spreads by providing data rooms, marketing, and legal templates. And to conclude, I would like to say indeed that these platforms are good instruments to reduce NPLs. Particularly, these are good instruments to increase price tension in the sales process. However, the large precondition of efficient operation of these platforms is strong enabling environment. And what we understand by enabling environment here, it was discussed already that regulatory framework needs to be in place, feasible tax environment needs to be in place, enabling environment, and insolvency frameworks in order for investors afterwards to resolve these NPLs. Because if banks right now are struggling to resolve within the current frameworks NPLs, most probably investors will be struggling to do that as well. So therefore, if enabling environment is in place, then there is this tool of using online platforms could be well done. And from our experience on the survey, what we did, I can say that experiences of Comco and European Deposit Guarantee Fund are good examples, and that these platforms can maximize success of NPL resolution. I'll stop here. Thank you very much. And I'm happy to answer questions in the Q&A session.
Thank you, Khalid. Thank you very much for your introduction of quite a subtle difference between internal and external system, among others. And hopefully we can have some time to delve into some more details on this issue later. So I heard that the other speakers from the EBA and IFC have mentioned your name, Burkhard. So it looks like you are at the center of all these activities and recent developments. So now you have the floor to share your insights.
Thank you. Yeah, thank you very much for the invitation, and also congrats to Peter and Richard for the report. I think it's very informative. Last week when I received it, I immediately handed it to our new hires and said, if you want to know what NPL transaction platforms are about and why we are an NPL transaction platform, please read the report. So great work. So we are, I'm the CTO of an NPL transaction platform based in London called NPL Markets Limited. We are 4 years old, mainly active across Europe, 23 jurisdictions in Europe, plus now in the Americas, including the cooperation with the IFC that Mahima mentioned in Mexico and Brazil. That's relatively new. It started this year. It takes us typically around 3 to 5 months to onboard and enter a new country because it requires legal and regulatory due diligence to be done. We have to adjust our technology to the country situation, but it is a relatively swift process. So we are a transaction platform. In the words of the reports, we are also a data warehouse and provide ancillary services, in particular around data preparation, validation, reporting, and valuation services. For us, they are extremely important because non-performing loans are very information intensive, and the data are a key challenge for sellers to achieve a good purchase price, to overcome the bid-offer spread that we heard about that exists in many markets. Also in more mature markets, we do encounter mismatches between buyers and sellers' expectations of pricing. Better data, more data, and standardized data can help overcome these information asymmetries. And we developed a technology infrastructure to receive a large number of portfolios in non-standardized form, standardize the information so that we can use it on our online platform for automated valuation purposes, and then also when the transaction is deemed feasible to put it on the marketplace and transact, invite investors and transact. So in terms of marketplaces or online transaction platforms, there are different variations of those, and maybe that was not so obvious from the report. There's quite a difference whether one has a B2C business model, where one tries to sell assets to individuals. For example, judicial auction platforms are often like that. They operate in China. We heard there are quite a number of those platforms. We are a B2B platform selling purely to the institutional investor market. Typically portfolios that can range from a claim value of 10 million to $500 million, euros equivalent. And we have processes with 1 or 2 bidders, but we also have processes with up to 60 bidders that initially enter the process and then reduce over time as the process advances. So in terms of the loans we trade, we are roughly split half and half between retail loans and wholesale loans, including commercial real estate, secured and unsecured corporate loans, trade finance claims. There we had our first Mexican transaction recently, which were coming out of the trade finance energy sector. So sometimes very special assets that enter the marketplace. And we try to standardize the information. We were one of the early adopters of the EBA NPL data templates that we heard Oleg and Lydia talk about. We find that standardized information very useful, and we look forward to that standardization step in Europe. Right now, over the last 4 years, we had to deal with very heterogeneous information and had to first put a data preparation and standardization step before we could actually transact and value the data. So hopefully that standardization is going to be, the degree of standardization is going to be higher, at least in Europe, after the new templates become mandatory. There's also the difference between primary and secondary markets. Primary markets where a bank sells a loan that they originated for the first time. Secondary market is where the investor or debt collector sells typically a tail of a portfolio that they acquired previously a few years down the line. Both are important, so both see activity. Again, when you set up a platform, that primary versus secondary market, wholesale versus retail are important considerations to take into account. In our marketplace, we are trying to cover what we call the data value chain of a non-performing loan transaction. So have the entire data-related processes online, from extraction of the information, standardization, transformation, validation, we call that data preparation. Then we have a standardized data set that we can upload to our data warehouse, and we can use our evaluation routines. Valuation requires more than just receiving the data tape from the seller. It requires assumptions to make these projections, how recovery cash flows occur and expenses that occur over time for a discounted cash flow analysis. So that's the valuation aspect of it. There's often a degree of optimization around what is actually the best portfolio to sell. So a selection and optimization step before then the seller actually enters the marketplace and invites investors on an invitation-only basis to participate in a transaction process managed on the marketplace. We are often being asked, how do we get our data? And that process that I just described, the seller sending us a data tape, sometimes including historical data, is an important part of the data gathering and accumulation. There's another part, because we are also offering a reporting service where we help loan servicers, banks, and investors to monitor their existing exposures, how the cash flows come in on a month-on-month basis, how these cash flows, these actual cash flows relate to their original projected cash flows, which we call the business plans, so that how different servicers, many large banks or work with different services, how the different services perform on the different segments and different business lines. So that's what we call reporting, and for us it has been a very successful and important part of actually getting data from large financial institutions, because we could give them that reporting service in return. And while the data is confidential and we can't share it to the outside world, we can use the data to extract our own assumptions for valuations, extract our own recovery curves from it, and use it in our valuation tool. So hopefully that describes our activities in a nutshell. Looking forward to the discussion.
Thank you, Bukhar. Thank you very much. So we are a bit, not a bit, but far behind the schedule already. So I have plenty of the pre-arranged questions to put on the table, but without having such a privilege, perhaps I can open the floor at this juncture in case audience have any questions or comments or feedback to pose to any of the speakers for this session. So any questions or comments or feedback you would like to share? Yeah.
Thank you. Hi, my name is Patipan Pasuwan. I'm from Sukhumvit Asset Management in Thailand. Actually, I'm working in the NPL acquisition department of my company. The question is, in Thailand, there are many. The situation of the NPL market in Thailand is not the market for the buyer; it's the seller's market. I mean, the bank has its own protocol. Each bank has its own format in giving the data to us. So I found it very difficult to get many different formats, even if it's the same bank. When they sell in, suppose bank A, they sell several times, they may come up with many several formats. So, and that cannot be controlled by the Bank of Thailand, because selling NPL is subject to each own in each bank. It's not mandatory. So is there any chance that you would recommend us to talk to the bank or the Bank of Central Bank to, I mean, by using the name of ADB to support AMC in Thailand, so that we can get the data in a more standardized format and make our life easier? Because I have to spend like 2 or 3 days just to get the information from the data tab and transform into my own format. That's the pain for all the AMC in Thailand. Thank you.
Okay, thank you very much for the question. I think that the question is quite relevant and a valid question to put on the table. I mean, the imbalance in the NPL market and the sellers having upper hand compared to the buyers. And I also have some similar question or concern in a sense. For example, if I don't think that we can have a unified online platform and eradicating or eliminating the over-the-counter market. Perhaps we will have to run the dual system of the online platform as well as the over-the-counter market. And whether there could be some tendency that the sellers try to register the low-quality assets in the platform while keeping the high-quality asset to engage some transaction in the over-the-counter market. So it's a bit similar type of question to what was raised by our Thailand colleagues. So any panelists that would like to respond? So if EBA, from your experiences, have any the observation or perspective to share with us, then we would be very grateful. Then perhaps we can go to the Bukhar to share his own perspectives. Yeah. So would Oleg or Lydia have any feedback on this question?
Well, I'm afraid it's quite challenging to comment on the point what assets are being sold where. As we are a regulator, we are not following the actual transactions and not part of any transactions. But I mean, I do share the concerns regarding the data quality, and that some assets have better data quality, and then you may decide to use some other tools. This is the issue very known to us, but at the same time, the way how the European regulation here is designed also not helping very much with the enforcement of the data quality. So we have the standard for the data quality, the templates, which we will become now. First, they were voluntary for anyone use, and then frankly, if parties decide not to use them, they will not use them. And now the standards will become mandatory, but again, there is no role for the EBA or supervisors to enforce the standards. So this is a bit of the market discipline and some role for the platforms being as a gatekeepers and to enforce our standards through their own admission to the platforms and through their own data quality processes. But I'm afraid cannot comment anything more on that.
Okay, thank you. So perhaps the Bukhar can share your perspective on this so-called adverse selection problem and the sellers market dominating the NPL platform. So please.
Yeah, so actually there was there are different answers here. One is the market a seller's market? Probably yes, because they are in the control of the process. So yes, in that sense, they control what information is being shared. They control what type of process is being run, who is invited to the process. So in that sense, yes, it's a seller's market. And we as a platform are actually very, strongly motivated to tell the seller that they are in control of the process. It's not us controlling the process. They have to take certain decisions. Now, there are market guidelines, market standards to refer to. On the data templates, yeah, the IBA has done a great job in defining a common denominator data template that is meant to work in many jurisdictions. It's also not a European template. Yes, it was developed for Europe, but it is actually very applicable internationally. And typically out of these 150 or so data fields, 140 apply in every country. Maybe 10 don't apply because of your specific legal and regulatory regime. And there will be another 10 data points that will apply to you and will be important in your country or for your asset class that may not be covered by the template. So, but as a common denominator, as a reference, it's extremely useful. So I could, there's also now a guideline from the European Commission on best practices on selling non-performing loans. Again, it was developed in Europe, but it is very generic and very applicable in other jurisdictions as well. I very much recommend reading that document. It's insightful. In terms of your specific problem, you receive even from the same seller, you receive different data tapes, sometimes even on the same asset class. This is exactly what we encounter and we have encountered for the last 4 years. We hopefully will see a change once mandatory data standards are in place, but this is a reality today. Everyone has their own data standards, and that's why that first step in having a reference point of a data template, and you see also in the data template what is the mandatory information. So there's a hierarchy of data fields that are more important and others are optional, so slightly less important. That helps. And you can immediately point out to the seller, here is a reference and you haven't supplied me with 20 or 30 mandatory fields. Can you please check whether that's available? So that's helpful. It doesn't, of course, the seller may say, I don't have it. We hear that all the time. But of course, it's a give and take. And if the seller wants to achieve a good price, they have to disclose as much information as they have. So it's also, I think, important to recognize that this common denominator is something, it's a standard, but it's not all encompassing. There is always, in every transaction, there's something that is found out, something specific, for example, some deficiencies in the claims that are just not, that are very important economically, but are not covered by the template. So the template is not the whole truth, but it's a very big part of, that's why I call it a common denominator. It covers a lot of important ground, and it needs to be supplemented with other information. For some portfolios, everything is in the template. For others, more complicated cases, you will have additional information requirements. In terms of making your life easier, technology can help, but in our experience, it does require also expert knowledge. Yeah? You can't just feed non-standard data to some machine and the machine will figure it out all by itself. It doesn't work like that. But if the machine is fed by a knowledgeable advisor or transaction platform, it can become a much faster, much more efficient process. And so when we started, it took us about maybe a week to put a portfolio on our platform in our data warehouse. And now we are down to minutes sometimes or hours. So not because we can avoid manual intervention completely, there's always some expert knowledge required, but because the technology is supportive and a team is experienced in dealing with very heterogeneous information coming from different sellers or even within on different asset classes or even within the same seller.
Okay, thank you, Bukar. Thank you very much. I think standardization and data template and the transparency should be the bedrock of the nurturing the ecosystem of the NPL markets and the NPL online platform. And also as countries accumulate more and more experiences, and also the market size of NPL becomes larger and larger, and with the high degree of transparency, this kind of imbalance in terms of market power and information asymmetry can be resolved over time gradually. That's my observation. So any other question from the audience floor?
Can I have two more questions? Small ones,
Yeah,
two
sure,
small
sure.
ones.
Yeah.
Just want to know, suppose we get the data tab with all the information and it contains info like collateral type and mortgage value or collateral value, that sort of thing from appraisal value. And also they state about the legal status in the template. Normally, when we do the due diligence, do you go to see the actual document, the real documents that is the original copy of the information in the data tape? That's question number one. Question number two is, suppose that suppose you won the bet already, and when the data is transferred to you, you found out later that it's not comply, it's not like that, it's not like stated in the data tape. Do you have the clause to return or put back of this client, I mean this debtor, to the original buyer? And how long is the putback period for this?
So, Richard, would you have any quick feedback on this? We don't have much time, but if you would like.
I think so the ability to put particular loans back, it's very much a matter of negotiation. I think clearly from a seller's perspective, they want to minimize that to make the transaction as clean as possible. And I think in terms of when they do their initial portfolio selection and defining the perimeter, a part of that may include identifying and excluding areas or types of loan which are potentially problematic.
Okay, thank you. I feel sorry about this, but we don't have much time anymore. I mean, because we have another coordinating council meeting after a short break. So perhaps we have to wrap this session up. But as was mentioned by Bukhard, please, I mean, this new report, titled the roadmap for developing online the non-performing loan trading platform, is available from ADB website. Please download the report and have a look. I think that this will be a guideline and the key reference material for the IPAF countries and IPAF members to have a further discussion about how to develop this online regional platform ideas further, and through concerted efforts and the collaboration and coordination. With that, I think that we have come to the end of this session, although we could not have enough time to entertain all the questions from the audience, but perhaps this is good and important leap forward, and hopefully we will see some tangible and concrete fruit to be born in the foreseeable future through your collective actions and efforts in the coming forward. So with that, I'd like to ask you to join me, give a big applause to all our distinguished speakers who have shared their insights and perspectives and views with us. And thank you very much.
Thank you
so much. Thank you so much, Jung-woo and all panelists. And if you have any questions, you can just send us the email. We can circulate with all panelists, because they are really expert from all different kind of international institutions. So you can ask any kind of things. And also this concludes today's IPAF conference. We do appreciate to everyone who participated in this event virtually and in person. And we kindly ask for your continued support for the ADB Regional Cooperation and IPAF activities. And thank you so much. And I hope you have a good time in Manila.